The central banks don't like it, the consumers hate it, the economists don't like it, the government doesn't want it. The fact is, almost no one likes high inflation. And yet, that's what India and countries all around the world are facing, with high and rising inflation posing a big threat to our standards of living. Now, as investors, we are exposed to inflation in many ways. There are interest rate changes, consumption patterns can change overnight, growth projections might go for a toss, all of which can bring down our investment portfolios by quite a bit. And so in this video, we shall take a look at some of the assets that are labeled as inflation hedges and understand if these can really defend our portfolio or not. But let's start with what a good inflation hedge should have. Well, firstly, it should be able to quickly respond to high inflation, and that happens with the asset bumping up its nominal returns. For example, what if your salary was not fixed but you were to receive an inflation adjusted salary? Which means if and when inflation were to go up by 5% beyond an acceptable level, then say your salary also goes up by 5%. Sounds a little impractical, but that's what I would look for in an inflation hedge. A second characteristic of a good inflation hedge is that it should work reliably across different time periods, geographies, and inflation regimes. You see, we all think of inflation to be a demand-led phenomena. That is, if there is more demand for a product, then the price goes up. But inflation can also be a supply-driven one, like what we are seeing now with shortage of food grains, semiconductors, palm oil, and the many logistical challenges that countries and companies are facing. So essentially, a good inflation hedge must work across different inflation regimes and scenarios. And the third and final characteristic of a good inflation hedge is its ability to deliver reasonable long-term returns. It is in this context of evaluating performance that we shall refer to a study titled The Best Strategies for Inflationary Times, which was published in May last year. This study evaluated the performance of different asset classes across the last 8 high inflation periods in the United States, which extends to almost 100 years from today. And yes, while times have changed with high money supply and increasing fiscal deficit becoming the norm, there are some elements of the study which I found very relevant in our understanding of today and how some of it is applicable from an Indian context. Let's begin. Per the study I mentioned earlier, energy as an asset class delivered an average of 41% returns across the 8 high inflation periods that haunted the United States from 1926 to 2020. And while we don't have such broad information on Indian indices, the Nifty's more recent performance does exhibit a similar trend, with the Nifty Energy Index being the highest performer amongst all indices for the year 2022. Now, picking energy during high inflation periods is not a sure thing. After all, energy did deliver negative returns in 3 of those 8 high inflation periods. But from the look of it, periods of supply-driven inflation, remember, not demand but supply-driven inflation, seems to bring out the best from energy investments, and that's something investors might want to look out for. Having said this, the energy sector does come up short when presenting itself as a long-term asset class. So while there is that 41% real return during high inflation periods, the energy sector averaged a negative 1% return during periods of low or manageable inflation. This gives the investment in the energy sector an average return of just 3% across the entire timeline. So to sum up, while energy stocks had a great last year, a year and a half, it does have a very lopsided risk-reward profile, which in our opinion makes a moderate to long-term thematic investment in the sector an unnecessary risk for everyday investors. It was about 50 years ago when the United States ended the convertibility of the US dollar into gold. This was a consequential decision because until then, foreign central banks had been able to convert US dollars into gold bullion at a fixed price of $35 an ounce. This had imposed a strict monetary discipline on the US Federal Reserve because inflating the money supply could have caused a run on the United States gold reserve. But since 1971, the price of gold has grown by about 50 times, and so has inflation, And it is this apparent correlation between gold and inflation that has led many of us to believe that gold is a good inflation hedge. Strangely enough, this belief is not supported by data. You see, if gold were to be a good and consistent inflation hedge, then the ratio of its price to the consumer price index should have been relatively steady over these years. However, as this graph shows, this ratio has vacillated from a low of 1 to a high of 8.4 over these last 50 years. Now, having said this, gold has shown signs of delivering high performance in times of high inflation. It did that in the 1970s when gold returned an average real return of 130%, while US stocks during the same period delivered a negative return of 12% per annum. From an Indian context and per the World Gold Council, for every 1% rise in inflation, the demand for gold in India soars by 2.6%, which fuels the price of gold and serves as a reasonable hedge during high inflation periods. We looked at some further data and observed that when the inflation rate crosses 8%, gold tends to beat equities, bonds, and treasury returns. But surprisingly, the same data also says that when inflation hits 18% or more, gold's return is slightly negative, which might be more on account of the speculative activity around gold futures, the hoarding of gold, etc. So from an everyday investor's perspective, one can look at gold in two ways. Firstly, having some gold in your portfolio is useful as it effectively counteracts high inflationary periods, plus gold has a weak correlation with equities. And secondly, keeping gold as an asset over the long term does give reasonable returns, but is unlikely to beat equities. So that's another point that one needs to keep in mind. Tangible assets like real estate have historically been seen as inflation hedges, and in the context that their value rises in line with inflation. And there are several reasons why this should happen. Firstly, there's the fact that real estate is an income generating asset, and investors do flock towards such safer assets when inflation rises. Secondly, and just like what we see with gold or commodities, there is the scarcity factor, as there is only a limited amount of real estate to work with. And thirdly, the increase in overall prices can be passed on to a tenant under most circumstances, which preserves the yield of the property. However, whether one buys property or invests via a real estate investment trust, what the investment does not do is to offer a high real return like what we saw with energy and gold in previous sections. In fact, the US data shows that inflation adjusted returns on real estate are within reasonable limits, and in a number of cases it actually turns negative in some high inflationary periods. Again, this data here is specific to residential real estate, and with commercial real estate the research we have done shows that the returns are a bit better. But to put it broadly, prima facie we didn't find much evidence to tag real estate as an inflation hedge, and when we add the fact that the sector goes through massive boom and bust cycles, the risk-reward ratio does become a little lopsided for everyday investors. Equities have traditionally been viewed as an inflation hedge on the premise that a company's revenue and earnings would also rise with inflation over the course of time. This theory does hold its ground over long periods of time, but over shorter periods this proposition does have some cracks. Our examination of inflation buckets on the US stock market data from 1947 onwards does show that higher inflation regimes do push up the nominal stock market returns. However, on a real basis, the inflation does eat into one's equity returns, as we can see when the inflation level crosses the menacing 10% mark. Now, different sectors perform quite differently in their handling of inflation. For example, there is a list of sectors that generally do well, and there is another list of sectors that don't do well during periods of high inflation, and especially when the inflation crosses the 10% mark. So yes, if you are a long-term investor, then your equity investments will probably and handsomely beat inflation. But if you're more tactical, then you can do some further research around these specific sectors before considering investing in them. And finally, we have cryptocurrencies, which were once touted as the greatest hedge against inflation. The theory was definitely sound. After all, cryptos have a limited supply. They are fungible, meaning one Bitcoin can be exchanged for another without any loss of value. They're also easily accessible, have growing acceptance, and cryptos have proven to appreciate in value. But cryptocurrency prices are extremely volatile on account of the speculative activity surrounding it, and it is hard to see if there will ever be any actual price discovery in this asset. This essentially makes the relationship between inflation and crypto prices a more theoretical exercise which may lack any kind of causality presently, and therefore it is our opinion that it is next to impossible to draw any reliable conclusions from it. The 2021 study on best strategies for inflationary times found that commodities, and more specifically energy and gold, turn out to be the better hedges against high inflation. But the truth isn't this straightforward, and we discovered in earlier sections that every asset class does come with some baggage. For example, in the case of gold, we know from previous videos on the ET Money channel that the yellow metal offers moderately long-term returns of 8 to 9%. However, there are also stretches running into many years when the needle just does not move and gold prices operate within a narrow range, often paying no heed to inflation levels. Similarly, commodities go through massive cycles of super high peaks and super low troughs, making it very difficult to time any of these. The study also concluded that real estate as an asset class does not offer much help, and bonds and equities both perform poorly or just on par during times of high inflation. And while some sectors within equities do have a better chance at tackling inflation, one can't shake the issue that these are not permanent solutions, and investing in thematic opportunities do come with their own problems of timing and risk management. But here's what we do know. Firstly, if you are an accumulator, then relying on equities to beat inflation is a tried, tested, and successful strategy which is likely to persist for many more decades. Secondly, investors can explore some reliable buy and hold methods to hedge inflation, like creating a ladder of individual gilt funds of different maturities. And I think we don't have a video on this, so we'll try to create one on this soon. And thirdly, with multiple assets performing differently at various inflation gauges, the importance of asset allocation and timely rebalancing only multiplies, which is where ET Money Genius and its intelligent investing service comes in. If you haven't tried Genius, then do check it out on the ET Money app or website. And for more details on the same, do check out these videos in English and Hindi, whose link is available in the description of this video. And with this, we come to the end of this video. Remember, there are no fans of high inflation, and what goes up will come down. Hopefully, some of the data we have presented today helps you see the picture better. And with inflation being a continuous topic of discussion and intrigue for our researchers, we'll be sure to post more updated content on it in the weeks to come. So thank you for your time. Do like this video, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.